In the advisor world, they call it unsolicited, meaning people came and called their advisor and said, I want this Bitcoin ETF. That's the only way the buys are coming in now. So all this, we would call this as incoming. There hasn't really been a lot of solicitation from advisors. That's coming, believe it or not. So all this is without solicitation, which is a really good sign.
It's Thursday, May 16th, 2024, and this is Markets Daily, a show where we get into the minds of some of the smartest and most experienced investors, traders, analysts, economists, professors, anyone with a smart or hot take. I'm Jen Sanasie. Before we get into our discussion today, let's take a look at what's going on in the crypto markets. Bitcoin rose over 7.5% on Wednesday, capping its best performance since March 20th. Weak U.S. data that we spoke about on this show yesterday strengthened the case of a Fed rate cut in September, and Bitcoin is reacting. The Bank of England and the European Central Bank are also likely to cut rates in June. The leading cryptocurrency by market cap is above $66,000 this morning. Let's talk all about what's going on, but more specifically, let's talk about what's been happening in ETFs this year with senior ETF analyst at Bloomberg Intelligence, Eric Balchunas. Eric, welcome to the show.
Great to be here. Thank you for having me.
Thanks for being here. Now, we start this show off with a call of the day. I got to get yours.
I write about stuff that's not Bitcoin, but I think this appeals to the Bitcoin mentality. We wrote about uranium ETFs recently, and we're predicting they're going to take in $10 billion or grow to $10 billion by the end of next year. We call it green investing for realists. Nuclear reactors are starting to open up again in the United States and all over the world. And if the world wants to have a shot at net zero, we just feel like nuclear has to be part of the solution. But there's obviously a lot of mental hurdles that people have to get over because it's kind of got tied with like meltdowns and stuff. But it's a fascinating topic. But those ETFs are another area that we ETFs cover everything. So that's something I just wrote, and it's just fresh in my mind, even though it's not Bitcoin related. Hopefully it's somewhat interesting.
That is super interesting. And we don't only talk about Bitcoin on this show. I'm going to go and check out that article after we record. But let's get into some crypto ETFs. That's what people do. Tune in to the show for. They're, of course, approved in January. We are now sitting in May. Just briefly, just quickly, take me through the last couple of months, the ups and downs, and anything that you might have been surprised about on this short but exciting journey that we've all lived through.
ETFs have a certain pattern to them. These ETFs have largely broken a lot of patterns that I'm used to. We had a feeling there'd be a big first couple weeks, and there was. Then there was like this dive down, and I was like, okay, they're going to settle in at a couple billion. And, maybe if there's a huge rally in a year, they'll pick back up again. But they had a second wind, like, I don't know, a month and a half in. And the second wind was really strong to the point where they were taking in like $500 million a day. And I was like, wow. I didn't expect that. That's when I think they crossed 70,000. The Bitcoin crossed 70,000. Then they had another breather where they came down again, and I thought, okay, they're going to settle. But now they're having like another, I guess I'll call it a third wind. They took in 300 million yesterday, and it's impressive. I never doubted the ETF as being something that would really bring in people, because ETFs, I dedicated my career to them. They make everything so easy. They standardized every investment, whether it's oil futures or China small cap stocks, junk bonds, or Bitcoin. You just click buy, and it's an ETF, trades like an equity. Everybody has access through brokerages. It's just the easy button. And so I knew there would be success, but the question was how much, and what would a downturn do? And so we have a lot of evidence now. And I think what you're going to expect is, when there's a nice rally in the works, you're probably going to see some inflows. And then when there's a downturn, you may see a little bit of outflows. I'd say maybe 3-4% of the assets might come out. But the majority investors are pretty strong, I think. And the inflows that come in will supersede the outflows. So over time, you'll probably have more net inflows. And so right now, I think we're at 11 billion of total net inflows since they came out. And our prediction for the first year was 10 to 15. So they've already sort of gotten to the middle of where we predicted in the first year. Now, they could lose money still. I doubt it. I think they'll probably end up higher than our prediction. But man, what a launch. I mean, obviously, by many metrics, the best launch in history. It's been fun to watch, fun to cover, and fascinating on many levels.
I guess I want to hear your perspective. The most successful ETF launch in history. What does this tell you? What does this mean for Bitcoin? What is it about Bitcoin that was able to make this so successful, do you think?
Yeah, look, I think a lot of the people who bought the Bitcoin ETFs so far are people who probably had some interest in Bitcoin. I do not, because in the advisor world, they call it unsolicited, meaning people came and called their advisor and said, I want this Bitcoin ETF. That's the only way the buys are coming in now. So all this, we would call this as incoming. There hasn't really been a lot of solicitation from advisors. That's coming, believe it or not. So all this is without solicitation, which is a really good sign. I didn't know if there'd be this much pent up demand. There's a little more than I thought. I also didn't realize the volume would be so high. IBIT trades over $1 billion a day. That's like top 1% of all ETFs. And that volume is going to attract bigger institutions. So I predicted that, there would be some of this, and that I just thought these numbers would take a year to happen. That all happened in a couple months. That's the one difference. But I get the take. I get the case for Bitcoin. If you're a 60-40 investor, I know a lot of people in the Bitcoin world are like all in, like that's all they have. But for like the most normal people, normal, no offense, but regular investors,
We call them
yeah,
normies.
normies, yeah, like I mean, I think it's a little more rational to have diversification, but I get it. Some people go so far they think the 60-40 is a scam, which is a whole nother conversation. But the normal 60-40 investor, in our view, they have a great deal. It's like utopia to be an investor now. You get all your stocks and all your bonds for almost no fee. So it's almost like this cheap core, but it's boring, and you got to wait 30 years for it to compound. And there's a little slice in a portfolio now for hot sauce. And we just feel like these fit perfectly in your hot sauce bucket. They're not competing with like stocks and bonds. They're sort of a speculative investment. And I think for a lot of people who buy it, they may not need to get the whole story of Bitcoin or even understand how it happened. But if they can, I think a lot of them just have this thought of like, look, I don't want to kick myself if it goes to $1 million. I also I do acknowledge the dollar has been devalued, and maybe if this can store some value and give me more real return, that's good. That's the digital gold case. So I look at Bitcoin as, light gold, but as a teenager. It's like it's stealing the car. It's going crazy. It's got attitude. So it's very volatile. So while it is a store of value, it's super volatile. So I do think people are using it more like hot sauce, not like an alternative yet. But that's okay. And I do think because the rest of the portfolios for 60-40 are pretty boring, people are on the hunt for some excitement. So I think it fits well with the modern portfolio. The only problem with what I just said is the hot sauce bucket is a tiny slice. So let's say 1% of all advisors put in the Bitcoin ETF. They'll have $30 trillion. So that's like $300 billion, but it's not the whole portfolio. So I do see a ceiling at some point because I just don't see normal people like going all in. I see maybe most people doing like 1%, couple true believers or, people who are real into it, 3 to 5%. And then there'll be some people who just will never go in. They're just not going to invest. So maybe you get an average of 1 to 2% over time. That's sort of how I see this playing out, but we'll see.
Let's talk about the 13 Fs that were submitted recently. I know you posted a lot on X about them and what they revealed, but just lay a foundation for the audience here. What is a 13F?
Yeah, I know. I've had to kind of go back to my roots a little bit in this and have to re-explain everything about ETFs because the Bitcoin crypto audience is new and they're not familiar with all these terms. 13Fs are if you're a professional or an advisor and you have over 100 million in equity holdings, you have to file a 13F and tell people what you hold. Only the equity side. You don't have to tell them the bonds or anything else, but just the equities. So think about it. If you have $100 million in equities, you're a pretty big deal. So that's why 13Fs are interesting because they tell us what the professional elite kind of investors are doing. The people who like have a real brain for this stuff and have their careers based on it versus retail, which, they can just buy it on their brokerage. So these 13Fs, I think at this point of all the Bitcoin assets, maybe 15% of the assets are represented by 13Fs. So 85% is small retail or advisors that don't have that much money. So we'll call those smaller investors. So it's largely small, but the 15% that we saw was interesting. First of all, it's rare to have any holders for a new ETF. Most ETFs have one, two, maybe three holders in their first 13F season. IBIT had 414. Fidelity had
That's
like
wild.
250. Collectively, they had like well over 500 holders, as a group. It's ridiculous. I mean, that's unheard of in ETF history. And IBIT in particular had almost every institution type represented, family office, insurance company, pension, investment advisor, trust, brokerage. The only thing I didn't see was endowment, but I'm sure that will come. That is all very impressive because if you're a new ETF, what you want to see is you want to see a mix of investors and you want to see, a mix of trade sizes. And that's sort of what's playing out here. So I see that 15% growing to 40 over time. I think the larger investors typically they don't bite right away like a fish. The small fish bite right away like retail. Bigger fish, they want to swim around the hook a little bit, make sure that bait's juicy. So over time the bigger fish will come in and I think you'll find 40% of all of the investors will be represented by 13F. So right now we're at 15. I see that expanding, but just to be at 15 and have, 500 holders represented, it was a great insight into who's buying it and why. It's like I said, it's not all the investors, but it gives you a peek.
Yeah, one of the things that was revealed there was Millennium Management, an international hedge fund, holds almost $2 billion across 5 different spot ETF products. Why might they do that? I saw someone ask you that on X, and I was like, "Oh, that's a pretty good question. Your answer is pretty good. Why hold this across 5 different products?"
Yeah. So the answer is I don't know. Hedge funds do all kinds of. They're harder to they're harder to case. Investment advisors typically buy one ETF and they go long, and that's that. It's very easy. Hedge funds, you don't really know what they're up to. Probably they bought four because they are concerned about moving any of the markets or being seen. They maybe have they don't want to have like all their money going into one and then they'll call that impact costs. So they spread out the trades. They might have rules about being a percentage of the ownership of one fund. Like they can't make up more than 2% of the holders. They could have an internal rule about that. There's a variety of reasons. Like Bridgewater, which is the world's largest hedge fund, I know they own SPY and IVV. Those are both S&P 500. So it's common for them to own a couple. No big deal there. Some people have said it's possible they are doing some arb in between the ETFs and the futures. That's possible. Some of these hedge fund ownership might not be straight, hey, we love Bitcoin. It might be them trying to arb the futures versus the spot versus the ETFs, but that's okay. What that does is it makes prices come together for everybody so that nobody's getting ripped off over here and buying here. Arbitrage is like the magic sauce that keeps everybody getting a good deal on the outside. So whether it's them going long in one of their like macro funds, or if they're doing this R business, that's still good. And it still shows you that like millennials, like no joke. This is a massive hedge fund. The fact that they're even playing in these waters already, and other hedge funds will see that at a 0.72, which is Steve Cohen's hedge fund. He's like a big deal. They bought Fidelity. Again, I don't know what they're doing with it, but there was I don't know, couple dozen hedge funds that are owning these. It's good sign because it just shows you that like these kind of people are going to attract other big fish, and that's just the way it goes. So regardless of their use, which we will never truly know because all we can see is they're holding, we don't know what the motive was. It's a good sign, and it's obviously going to bring more volume, tighter spreads, and so that's my take on that. I don't want to say Millennium loves Bitcoin because again, I don't know their true purpose, but they certainly were aware of the launch and thought, hey, this is something we should trade and get into, and that's just good. And people should just leave it there.
All right, Eric, I want to turn quickly to the Ether ETFs. That deadline is, of course, looming here. I think across the industry, across many different guests who have been on this show, optimism is kind of dwindling on those products. But we learned yesterday that ARC21 Shares amended their spot ETF application to remove staking. And when we heard about the amendments in the Bitcoin ETFs, that was good news. What does this tell you? Does it tell you anything?
Yeah, no. We were bullish on the spot Bitcoin ETF approval before it was cool. And I feel like we were bearish on the ETH ETF approval before it was cool. There were some other early people that, we weren't alone, but now it's like common to be bearish on spot Ether. And we get good intel. So we're talking to people. That's big. We also have noticed that there's been no comments on the filings from the SEC to the issuers. Normally, when you file something, especially new that's never been done, they give you comments like, hey, can you answer these questions? And it's a back and forth ping pong match to get the filing ready for prime time. There's been radio silence. So with SEC, radio silence is violence. That's our phrase. So the SEC has like deliberately said nothing, which is almost like them saying, we're not into you. We're not going to approve it. And I firmly believe next week we'll get the disapproval. They'll basically say why. Kind of unclear what they'll say. I don't know. But whatever they say will be interesting. Then the issuers will have to look at their rejection reason and figure out if they can counter it, whether they want to sue. My guess is everybody will lick their wounds for a while. There could be some big outcry. Twitter will obviously go crazy debating this. But I think everybody just cools it till the election. Because if the Republican side wins, it's very possible there's no need for lawsuits or anything. This will just get approved and everybody's happy. If the Democrat wins and Gensler is even if he's not the head, clearly that side is more hostile towards all this. That's when I think we get into other routes, like do you sue them or whatever. But I think we'll see a cooling off period until the election. That'll be the next big catalyst. But I am skeptical that there is a lawsuit. I don't see Grayscale doing it. They sued for Bitcoin and won, and when they finally they won, everybody came in cheap, and all of a sudden they have lost a lot of assets to BlackRock, who's been like the big winner. So is Fidelity. I'm not sure they're going to foot the bill again for that whole experience. So I'm not sure that we'll have a lawsuit. On the flip side, it's for people who are into Ether, it's a bummer. For Bitcoin people, it's a win because more money will go into Bitcoin. But Ether, to me, wasn't going to be that big of a deal anyway. To me, this was like the opening act following the headliner. Bitcoin is the big thing. So Ether, to me, would get 10, 15% of the assets. In Hong Kong, they did do both, spot, Bitcoin, and Ether. And I think Ether has 13 to 15% of the assets, might be 12% that Bitcoin has. So it's like silver versus gold. So again, it's interesting. We'll see it play out. But as an analyst and somebody who's been watching this for 12 years, at least Bitcoin is out. And these ETFs are out. They're doing well. And I also think that the success of the Bitcoin ETFs was a little surprising to the SEC and all the people in Congress, because it's like the genie's out of the bottle. Now everybody's going to have it in their 401k. And they thought, well, okay, fine. They're approved. Nobody will care. But I don't think they realize how popular these things would be. And now I think they're starting to have buyer's remorse. So I think that actually hurt the case for Ether even more, because now even two congressmen wrote Gensler, says, stop this, stop approving these things. So I just think unless there's a complete overhaul at the presidential level, I just don't see these getting approved anytime soon. Maybe at best end of next year or 2026. But everything that made us bullish on the Bitcoin side, the same kind of signals and intel has made us bearish. The ARC thing to me is more of something I think they did to like maybe mess with the SEC in their rejection letter to say, if you were going to say staking is an issue, well, we're not staking. I think there's something there with that. I don't think they were told by the SEC to remove it. I think either it's like a Hail Mary pass, or they're trying to maybe remove something the SEC might have used in the rejection letter. That's my guess on why they did that.
Eric, it's been such a pleasure hearing from you this morning. Thank you for joining the show.
Thank you for having me.